G'day, welcome to the Australian Property Podcast. I'm Pete Wargent, and today I'm here with Nehemiah Richardson from TermPlus. G'day, Nehemiah. Good to have you on.
Yes, thanks very much, Pete. It's great to be on.
No, pleasure. It's nice to mix things up a bit because today we're going to talk about TermPlus and what you guys do over there. But before we do that, just tell us a bit about your background and where you're from and something about your career and interests and so on.
Yep, sure. As you can probably tell, I'm from the US. So I grew up in Boston, went to university there, and then left uni and worked on Wall Street for a few years. So I worked as an M&A banker back then and came out here for 12 months. Then ended up being lucky enough to get involved in the Victorian sort of electricity and gas privatizations, and also the IPO of Telstra. So, which is when I met my wife, and she wasn't going back to the States, so I stayed. And then kind of post that, I've spent most of my career in financial services here. So either as, advising banks and insurance companies here, or actually working at NAB. And I've had one of a team of people when I was at Merrill Lynch that did the first ever hybrids. Now those hybrids are now going, but myself and a number of other people were sort of the pioneers of the hybrid market in Australia. So it's kind of interesting to see it go full circle and have these kind of hybrids disappear as a consequence of Credit Suisse merging with UBS and the hybrids blowing up. So it's actually quite funny to have some relation to those two things. And as a result of that, and my history in financial services, I've seen a lot in both, corporate credit, consumer credit, and structured credit, and all of the things that sort of underpin this trend that we have in global private credit, right? So it's not a surprise that when I had the opportunity to come and start this business, that it was kind of right in my wheelhouse of the things that I'm really interested in and the things that I'm passionate about. And one of those passions, goes to how you can provide really nice kind of stable investments for people. I've worked at banks. I've also worked at in telecommunications, but I've worked in businesses over the years that are kind of the fundamental underpinnings of productive society, right? So financial services, telecommunications, power or energy. The one I haven't done is education, right? But all of those things and delivering kind of those things are fundamental pillars to kind of productive society. And that's the kind of things that I get, really passionate about, because it's not just the content, it's actually about the purpose. So anyways, that's a bit about my background and how I ended up at Pengana. And then in terms of interests, if others have listened to the podcast I did with Owen, I'm a mad golfer. So you probably shouldn't get me started on that, because we probably won't talk about the topics that you want to talk about.
Yeah, we actually did that before we started recording. So yeah, it's a great city, Boston. But a lot of people come to Australia for a year or two and then end up staying for the long term. So yeah, I'll try to keep the subject matter off golf, but I'll try and get you up to Queensland at some point, and we can talk on the golf course instead of on the
100%.
podcast.
100%.
So I guess look, a lot of our listeners wouldn't be familiar with TermPlus. So just give us a sort of 60-second overview of what TermPlus does, what you can invest in, and what are the benefits of so doing.
Okay. So what TermPlus is, it's really just an alternative, a defensive sort of fixed income alternative for people. And what we sought to do was to provide attractive rates for 1 year, 2 year, and 5 year money. Right. So you have various alternatives there. You have term deposits. We are not a bank. It is not a term deposit. It doesn't have a government guarantee. But we do have fixed, but it is quite a defensive product because it's actually backed by, global credit, meaning bilateral loans to defensive, non-cyclical companies around the world in the US and Europe. And you get a really attractive floating rate income from that. So what we've done is created a vehicle that allows for people to very quickly and easily go online and invest 1, 2, and 5 year money on a floating rate basis, so it's protected from inflation. And the rates that we're able to offer because of the returns that we get from that overall portfolio allow us to pay yields that are quite attractive relative to other alternatives. So, for example, we have a 1 month product 1 year product, which is RBA plus 3%, right? So we're able to play 6.6% today. A 2-year product, which is RBA plus 3.85%, and a 5-year product, which is 4.15% over the RBA rate. So really nice alternative if you have cash that you want to kind of park for a period of time and earn really stable monthly income.
So for a lot of our listeners, so for example, if you've sold a property and you've got a big bunch of cash sitting around and it's in a bank account and you're not earning a particularly good rate, then that's where that kind of product might come in to the picture. I guess just to back up the truck a little bit, I suppose a lot of our listeners wouldn't be particularly familiar with what private credit is as an asset class. Could you give us a brief sort of overview of what the asset class is and how it's traded?
Sure. I think the first thing I would say is that, private credit is probably the one of the, if not the oldest asset class, in the world. And people laugh when I say that, but it's the truth. If you go back to kind of many, many years ago in the time of like the Medicis, if anyone who's into their history, basically, you started with bartering and then ultimately ended up with, trading companies that effectively needed financing to, buy what they were going to sell and then go and sell it. And that was actually the beginning of, what, I call private credit, because it was a bilateral agreement between somebody who had money and somebody who need money for their business, and they came to an agreement that then allowed for that for that transaction to happen, and the provider of that credit gets interest, and the person who borrowed actually pays that interest and then has to pay it back. Right, so that's been around for a very long time. In Australia, it hasn't been a big feature because 90% of the credit in this market has been to businesses and to consumers is intermediated by banks. Okay, so even if you got a mortgage from a non-bank lender, the reality is most of the financing that non-bank lender has comes from a bank, generally speaking. And so because of that, I think a lot of the types of assets that you see in the US and Europe in the global private credit arena, meaning where there's an investment manager that's actually lending money to a company in the US and Europe, you don't see here because the banks are actually doing that. So in Australia, you'll see that the 10% of the market that the banks don't bank is where we have private credit providers. And that's typically predominantly in commercial property, but there is some bilateral loans to companies, and there's loans to non-bank lenders as well that's provided by the private credit sector. So here it's not a big feature because it's only 10% of the market, and so not as many people are as familiar, I think, with the asset class. If you go offshore, it's very well accepted, been around since the GFC, so over 25 years, very well accepted that global private credit providers are the ones who provide 85% of the credit to, large segments of the corporate market that can no longer access banks because regulators didn't want banks or don't want banks, to fund longer term loans with short term deposits, and that's what's created this opportunity. And I guess the last thing I'd say about this in the US and Europe is that these private credit providers are hold to maturity lenders. Okay, so what that means is if you're a company, Pete, and I'm lending you money, well, I can't trade that after I lend it to you. I actually have to hold it. And so I expect you to pay me back, whether it be in 3 years or 5 years. So what that means is I'm very selective and very careful about how I do that. I'll look at your business. It's got to be defensive. It's got to be very predictable, because for me to provide you with a loan, I have to lever whatever you're trying to do. I really have to ensure that I'm going to get paid back. So not only do I care about what your business is and how predictable it is, the other thing I really care about is the risks that are associated with it. So I'll look at all of the things that could go wrong, and I will protect myself from that through the terms and conditions and legal enforceable rights that I have in our arrangement. And I think that's really, really important when looking at the global private credit asset class, because when you look at its net loss performance, it basically is, there's two things that come out of this. Number one, the net losses are exceptionally low relative to any other asset class that you can look at in credit in the US and Europe. Number two, you get a premium. You get paid a premium over what you would see in other types of credit markets because it's held to maturity. So as a lender, you get paid for holding this for the term, right? And the third thing, because it doesn't trade, it's not volatile. And that's why, big institutional investors and now increasingly, wholesale and retail investors love the asset class because you get really stable, really nice, attractive income. You get no volatility for that income, which means you get really nice capital preservation characteristics.
So thank you for the explainer. So as a prospective investor in a product like this, I guess the first questions I'll be thinking would be, right, who's in the team? What does the group look like? How much sort of experience do you have across the team? How long you've been in business? And also probably who are the big shareholders or the main shareholders in the group? And finally, how much, in terms of assets, how much do you have under management?
Maybe I'll start with the team and how we do it. The first and really what's really important in this asset class is that in the U.S. and Europe, this is a big phenomenon. This is it's been around a long time. It's only probably in the last kind of 5 years or so, maybe a little longer, become kind of really more exposed out. It's become sort of, people have become more aware of the asset class. And that's why you've seen this explosive growth. But it's been around with institutions for a long time. What's important is, in that context, what comes with lots of money going into the sector is lots of new managers that emerge. So it's really important, first and foremost, that you actually have a partner that's global, that has strong capability to identify funds, to diligence those funds for their track records, their alignment, their how they do business, their governance, et cetera. And so the first and foremost, what's important is we partnered with Mercer, who are one of the the largest asset allocators, advisors, and managers in the world. So they look after about 17 trillion of assets. They have a dedicated private credit business that's been around, since inception, and their sole purpose is in the private debt business at Mercer is to identify and diligence funds for investment purposes. And they they manage multi-manager funds or fund of funds on behalf of very large, sophisticated asset owners. Okay, so we partnered with them because you need a partner to identify, to access, to diligence, and build portfolios. And we benefit not only from that capability, we also benefit from the fact that they have significant buying power. So we have really nice kind of fee constructs that others wouldn't be able to access. So first and foremost, it's that. Secondly, with our team, so between myself and my partner, Adam Rappaport, we have over, between the two of us, we have over 25 years individual experience across specifically financial services. And so what we do is we manage how we construct the products from that portfolio to kind of deliver the different types of risk reward and or risk return and liquidity that different types of investors would want, but through their investments in global private credit. Pengana Capital Group itself has been around, for over 20 years as a fund manager that basically tries to find unique strategies. So if you look at Pengana Capital Group holistically, we have over $3.5 billion of funds under management across various funds in equities and then in alts. On the equity side, all of our strategies, for the most part, are unique sort of boutique type strategies that are relatively uncorrelated to the general market. And then on the alternative side, we're the first ones to do a listed private equity vehicle to allow investors sort of to get access to that asset class. And now we've done that with private credit through our association with Mercer. The final thing to say in relation to it is, our largest shareholder at Pengana Capital Group is Solpats, and they were part of helping provide us with initial balance sheet to seed the investments that we made in our portfolio. So we had a couple of $100 million of seed from Soul Pats that allowed us to kind of build our portfolio before we launched our first product. So people could see, okay, this is what, we actually have a working portfolio. We didn't just go and raise money and, we'll put it in a black box. We're able to say, here's a portfolio, here's what it's actually earning. And then it sort of then provides, I guess, visibility around not just the assets, but what the return profile was already starting to look like. Okay, so as a consequence of that, our first fund was opened in October 2023. We have a listed fund that opened last year, and TermPlus has been around about a year and a quarter. And our total funds under management across, our all of our various funds is today just under $600 million. And I think we have a growth profile that should take us quite substantially above that over the next, kind of 6 months or so.
Fantastic. Thanks very much for that. So I suppose we've talked a little bit at the outset there about the kind of returns you'd expect to get on the product. So the cash rate target, at least at the time of recording, is 3.6%. So if you've got cash rate target +3, then 6.6% or potentially higher for longer duration products. So could you just explain a bit for our listeners how you can target rates like this, so well above the cash rate, without taking on too much in the way of risky or volatile investments? Because I suppose in the spirit of there being no free lunches, presumably an investor needs some duration tolerance. So I guess the second part to the question is, what if I need my money out earlier? Is it illiquid? Can I add money or withdraw money to the balance during the term? And finally, just what at the end of the term, what happens then?
Okay, so I guess the first thing is the return. That how do we actually generate the return generate the return that pays the yield? So firstly, we have in our master portfolio across US and Europe, which are the mature, where you have the best managers in the mature markets for global private credit. We have a portfolio that then has, top rated managers by Mercer from the US and Europe. The second is, so we have a widely diversified portfolio is the point. Across US and Europe, today we have 24 different managers and over 3,500 individual loans in the portfolio. Okay. And from that portfolio, and there are multiple strategies because, we have both bilateral direct lending strategies to corporates, that are in defensive industries. And then we have some asset-backed strategies, which are, kind of where the yield comes from pools of assets. So if you think about some of the non-bank lenders here that would have, like in mortgages, you'll have lots of customers with individual mortgages, right? So the reason why we have different types of strategies and we have different geographies is to ensure that we have the widest diversification that we can. Because the one sort of free lunch, right, I guess you could say in credit, is diversification, because you don't get the upside, you only get the downside, right? So diversification and very wide diversification is your friend. It's very hard to diversify in this asset class. And so we have a very widely diversified portfolio from which we take investor funds and we invest across that portfolio to generate the yield. So when we set our spreads for the different durations, because broadly speaking, those strategies are longer duration. Okay. But what we have is within that, they all have various liquidity profiles. And as a consequence of that, we're able to create, like, our 1 year, 2 year, and 5 year money is actually done on the basis of making sure that we can manage individual liquidity of those terms and also then deliver the kind of yield. So the shorter the duration that you have, right, the lower the spread. The longer the duration you have, the wider the spread, because when we take funds in, we can invest them. The longer the lockup, if you will, of an investment, the higher return you get. And that's why with our different terms, we're able to allocate in a way that generates, a nice return for the investor, but also takes account of the fact that you have more liquidity on the short end, and as a consequence, a lower return, but still a very attractive one, right? And we're leveraging the return of the entire portfolio. Okay. Does that make sense, Pete?
I think it does. Yeah.
Okay.
So
I just want to make sure.
A diversified portfolio, but also with various durations, with what you're invested in, so that you can use that then to match against the investors that come on board. So
yes, and so the liquidity is really, and so it's really important with this asset class because it's relatively illiquid. It is really important that liquidity. Our liquidity is managed to ensure that we're able to deliver the liquidity against what we have available, if that makes sense. Because you'll find lots of different strategies in credit can sometimes have a liquidity profile that's inconsistent with their strategy. And that's why I think you'll see today that there's some funds around in Australia who've actually had to lock up investors' funds because their strategies don't allow them to get that liquidity. Right. So when you invest with us, we have our 1 year, our 2 year, and 5 year money, and for them, they're basically fixed. So you should consider your money locked up for a year.
Yeah.
Of course, by exception, if there's circumstances, hardship, or other things that create the need for someone to take their money out earlier, right, they can request that, and we obviously, would look at that and do the right thing by it, but. We like to say, and I like to be really clear with people that, if you're invested 1 year, think about this as 1 year money that is locked up. Okay. And we have between 3 and 6 months notice. You have to let us know that you're actually going to redeem. Otherwise, it will automatically roll. So I think that ends kind of 3 months before the end of the term. But we don't wait for that. We basically will be reminding you from 6 months on to ensure that you know that you actually have to make that decision if you want to get your money out to tell us, or if you want to roll it to tell us.
Yeah, because I guess if you're busy, you could easily forget the 3 month deadline. So good to get
100%. Right. And one of the great things about how we built our platform is this is a fully digital product. So think about years ago when I was at NAB, I was there when we did UBank. Right. And so UBank was the first real online bank that you could open an account with within 5 minutes with all the AML and KYC and those types of things. So we leverage that technology to open accounts for people and have them settle their accounts, with cash to start earning. But what that allows us to do as well is because it's on digital, it makes it really easy, not just for you to open an account, but it makes it really easy for us to remind you of those types of things and keep in communication. And you might not getting hammered with SMSs and emails to remind you of these things, but we care a lot about making sure that customers know what's actually happening and what they need to do and the actions that they need to take. And having digital is a really nice platform to be able to do that.
Yeah, for sure. So you mentioned earlier on that in Australia, say the banks would have like a deposit guarantee, but you guys aren't a bank. So I suppose as a potential investor, there's probably two things I want to know. Firstly, do you eat your own cooking? In other words, do you invest in your own products? I guess skin in the game. And then secondly, I suppose, is my capital at risk? So have you ever missed a monthly payment? How safe my money from a market crash? And what are the potential risks?
Yes. Okay. So I'm glad you asked that question because it's a very important thing about our product. Yes, we are not a bank, and so we don't have a 250 guarantee. Okay, but there's a number of things that we've actually sought to do in offering this product to, try to, de-risk and help people, or really to kind of de-risk the product and provide some additional protection and assurance for people. Okay, so the first thing is it goes to alignment. For every dollar that an investor invests, into any term in TermPlus, we invest 5 cents. Okay, so we put in 5%, and what's important about that 5% is that so we're side by side investing, and with our 5%, we don't earn any return on that money unless we pay the return to our investors first. Okay, so what that means is we invest 5 cents alongside the profit that we earn on our 5 cents is actually used to the extent that there was ever a situation where we couldn't pay the monthly yield, we would actually be topping up with our own. We would be topping that up with our income before we actually received it. Okay, that makes sense. And so therefore, and the other thing that's really important is it's on a rolling 12-month basis. So every month, TermPlus earns a profit. We actually then pay out our investor income first. If there was a shortfall there, then we would be topping it up with our own income. Okay, and we can't take a return, so meaning we can't take income out, even if there's a profit after that, we actually have to hold that for a rolling 12 months. So you can't just kind of take money out. It's actually captive to the fund. So we are very aligned because we are last in the list of anybody getting paid. So the first thing is you got an income priority. Okay, the second thing is if for whatever reason, you're investing at a dollar unit price. Okay, and that dollar unit price doesn't change unless there was a possible impairment in the asset value of the portfolio. So in the kind of remote possibility that happened, we would still be paying you as if you had a dollar invested. So in other words, the RBA plus 3 is always on a dollar, right? So if RBA was 0 and it was a 3%, to make it really simple for me, we'd be paying you that 3 cents. Okay, we won't sort of say, oh, it's that divided by 98 cents if that was to occur. And that's our what we call income stabilization. So we want to be paying you that monthly income because you're invested in us to get that reliability. Okay. And then the third thing is with our 5 cents, if at the end of a term we can't actually pay you back your money, the first 5 cents, so that 5 cents that we put against that basically has to go to pay out to try to get you back to your dollar. Okay, so we try to build those protections in place to kind of credit enhance or de-risk the investment. And at least, if it can't provide a guarantee, it actually provides, some additional insurance over the returns in the portfolio. But I think it's important to note, if you look at the diversification of the portfolio, if you look at the LVR, so our lending, say in our direct lending portfolio, there's LVRs of between 30 to 50%. You have information rights, you have legal rights to grab security. Our managers are able to intervene early if a company goes off track, but they're selecting companies that are kind of market-leading companies in defensive industries like, software providers, mission-critical software, infrastructure, utilities, consumer staples. We're not in things that are cyclical. So if you think about it, your starting point is the selectivity of really good, stable companies with really good terms that allow the manager to intervene. And I talked about that, that alignment that you have at the manager level, and then you have 24 managers, and then you have over 3,500 loans, et cetera. So all of that has to get impacted before you sort of start to worry about these additional protections. So I thought it was really important. So the portfolio is built for protection. The protections we provide are built there to kind of, enhance protection. And as a consequence of that, you'll see since inception across all of our funds, we haven't missed, we've been very stable. We haven't missed any payments. We've been very consistent.
Cool. Now I'm just trying to put myself in the shoes of the listener here, and I'm either a couple of cohorts. I'm a busy professional, and I've got busy sort of life going on with career and family, or alternatively, I'm a retiree and I'm busy playing golf or whatever. I suppose, do I need to be a sophisticated investor to invest in TermPlus? And do I need to be able to understand a complicated prospectus and a whole load of stuff about private credit? Or is it a relatively simple process, or is it somewhere in between?
Yes. So it's a very good question. So I would say it's a hard question to answer, but let me have a go at it, because I think it really depends. Okay, the first thing I would say is nobody should be investing in anything they don't understand. Okay, or if you don't understand it, you have to ensure that you have an advisor who understands it, who can advise you. That's what I would say first and foremost. Okay, so and if you have an advisor who can do that, you want them to do it simply enough so you do understand, the risks, okay, and how you get the return relative to the risk and whether that makes sense to you. Now, having said that, I'd say, for me, but I'll have that background. I think what's relatively simple about this is, when you invest in a bank, okay, so you can buy term deposits, you can invest in a deposit account, your at-call account. You can invest in a term deposit. If you're big enough as a wholesale investor, you can buy bank debt, investment grade debt or subordinated debt. You used to be able to buy hybrids, but hybrids will disappear in this market. Or you can buy bank stock. Now, to me, when you buy those things from a bank, you are basically buying. You might have a guarantee on your deposit account, but in hybrids, you didn't have that. Okay, and the hybrid market, tier one hybrids that you buy for income are basically equity that doesn't get upside. Okay, because because they don't have to pay you a dividend, and it's a first loss mechanism. That's why the regulators allowed it to be used as capital. The reason I say that is because that meant that if you bought a hybrid, you are taking. How do you get paid your yield? You get paid your yield by all of the loans that the bank makes, the profit the bank makes, and the residual profit goes to the depositors, the debt holders, the hybrid holders, and then eventually the dividend on the stock. Okay, so if you then think about the concept in a bank of I take in these different types of liabilities and I make loans and you earn a spread, that's the business. Now you go, well, how do they get down that track? Well, I look at what we do. We are not a bank. However, we have a portfolio of a bunch of bilateral loans that earn income, okay, that then pays the income to the investor. So that is a very simplistic concept, and I think most people can grasp that because they're already buying these instruments. The next thing I would then go is, well, if you go and look at our PDS, we try to explain, or we do explain exactly, what are these types of loans? How do the managers are important. How do we select the managers, et cetera, et cetera. So I feel that if you were to kind of take the time to read through it, it's very simple to understand what is the simple concept of a bilateral loan to corporates, to then generate income, to then pay your income. And we also explain, the losses and the relative loss performance. So in that context, it's pretty simple. The deeper you want to get into, just like in a bank or any other investment, the deeper you want to get into it, the more complicated it can become in anything that you do. But I think our PDS tries to really lay out what is this market? Why does it exist? How do we create our income? How do we select our mix? So everything that's really important to investing, I think we make really clear, and you just have to read a lot depending on how deep you want to get into it. Okay.
Yeah, that does make sense. I think so. I've just had a sort of read of some of your customer reviews. So it's termplus.com.au/review. So you can read some of those for yourself. And of course, as always, we'll link in the notes to where people can go to read for more. So I suppose my final question or questions is would be, well, how let's say I'm an investor in TermPlus. So how do I, just from a practical standpoint, how do I go about managing my account? Are there any associated fees? And I suppose sort of related to that, do you have a fee structure, or how do you guys get paid out of the deal?
Yes. So basically, there are fees paid to managers, right? So, but TermPlus itself, you as an investor, there are no direct fees. What I mean by that is if you put in $1, it's $1 and you get paid the RBA plus 3. Okay. Now, at the manager level, there are fees that are paid to those managers. So you could say indirectly there are fees because that money is managed by the 25 managers. But in terms of, there's no hidden fees in terms of what you're investing in and what your returns are. That's what you get. Okay. Then, secondly, I think, and your question was, so the first was about the fees. What's the second part of the question?
Well, I suppose just from a practical perspective, how do I manage my account? Is there much to do, or is it fairly straightforward?
Yes, no, and so it's very straightforward because, and this is why we built it. We built the digital platform. It's very easy for you, either off your computer or on your phone, to actually look at your balance whenever you want. Okay, we actually will every month send you an email and a text, unless you opt it out, that tells you what you're actually earning on a monthly basis. Right. So I love that because every month I'm getting texts. I look at my texts. I don't really look at the emails that I get. I get the texts, or I look at the text, and so it's really nice actually to be getting the text that tells you what you actually earned for the month on your income, because I'm an investor in it myself. So that's what we do. It's very easy, and we also have online chat, and we also have a call center of people actually want to speak with someone directly about, what's happening with their account. So from my perspective, if you're really busy, etc., it's a set and forget thing. We just kind of let you know that you're getting paid, and we consistently remind you to make your election to roll over or withdraw, or really to withdraw your money. We continue to remind you to do that right up to the end of the period at which you have to do that. So, and so in one of mine, I've been sort of getting consistent texts that keep reminding me to make sure, do you want to roll over? Do you want to roll over, right? Or not? And it's really nice and then it's really easy to do. You just kind of hit the link and you can make sure that you've confirmed that that's the case.
Sounds
for whatever
good
you want
to do. For busy people or forgetful people like me, it sounds ideal. So look, those were the questions I had for you, Nehemiah. Is there anything else I should be thinking about here as it relates to TermPlus?
Look, I think the only other thing that I would say, Pete, in relation to, maybe your audience would be that, just a use case for this. I think, TermPlus is great for anybody who has term cash where you want to get a higher return than a lot of the alternatives out there in a really defensive portfolio that delivers very stable monthly income and, really nice capital preservation. That's really important, I think, in different use cases. One is you just have income that you want. You want high income and you're a retiree, you're on a fixed income and you don't want volatility and you want that safety. Well, our product can provide that. The other thing is I sold my house at the end of last year, or my primary residence at the time. I'm not sure what I'm going to do. So currently renting, and we were downsizing. So we're not sure, we're going to buy another house because we have another house, but are we going to buy another house in town? And what did we want to do with it? Well, I put it in TermPlus because I wanted to earn a bunch on the money. I wanted zero volatility. Right? I didn't want it in the equity market. I wanted to ensure that if I decided at the end of 12 months to take the money out, or at the end of 2 years to take the money out because I want to buy a new place, etc., I need that flexibility. And so, for me, I think if you sell property, there are many different ways. If you are going to deploy that capital immediately, there are many different ways or many different options that you have depending on what your investment objectives are. But, for me, in my case, it was I wanted capital preservation. I wanted really good income. I wanted that compounding over the period of time until I decided what I wanted to do with the capital, because that's about preservation for me. It wasn't about kind of investing that in volatile assets. So I just thought I'd raise that because it's kind of, it's really good for people who might have that sort of use case. But please don't take that as advice. Take that as an example of a use case. And if that resonates with you, I would say you should have us in your consideration set.
Thank you very much. So where should people go if they want to find out a bit more about TermPlus?
Yeah, so if you go to termplus.com.au, we have heaps of information on our products, on the asset class, etc. And it's very, very easy, whether you're an individual or through corporate trustee or an SMSF. It's a really, it's a very simple and quick origination process. Very
Perfect.
easy to open an account. Yes.
Thanks very much. Yeah, well, as always, we'll put a link in the notes to where you can go as well. Nehemiah, thanks so much for explaining all of that for us. And I'll be down in Melbourne in the next couple of weeks, so I'll give you a shout for a coffee.
Definitely. It's fantastic to see you in person in Melbourne.
Great. Thanks so much. Okay. And look forward to chatting again.
Yeah, thanks very much, Pete.
Cheers.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.